It is Monday, and it is the second episode of Macro Mondays. Let's jump straight into the video. Last week we had a full capitulation on dollar and a massive rally on risk. I'm going to be covering exactly what I'm looking at for this week, a trade of the week, and also be covering the key narratives of what you need to stay ahead of if you are trading the markets this week. But before I do, I'd like to thank the sponsor of Macro Mondays, and that's Blackbull Markets. If you don't know who Blackbull Markets are, they are a New Zealand-based ECN broker with top tier banking liquidity. Go ahead and click the link anywhere below or around this video to go ahead and sign up with Blackbull Markets, especially for Macro Mondays. If you go ahead and click the link, you are going to get access to free TradingView Pro. All you need to do is click the link and go ahead and sign up. No minimum deposit, and you can go ahead and enjoy free TradingView, which is about $150 a year. So go ahead and enjoy that courtesy of Blackbull Markets. But without further ado, Macro Monday episode 2, let's jump straight into the video. Right, before I do the interesting stuff on the charts, this week, very big inflationary week. We have UK, Eurozone, and Canadian inflation. As we know, we have seen with the likes of the US, inflation drastically cooling. But I'd like to reiterate that if inflation cools, that does come with a side order of slow growth, so try and keep that in mind. So briefly to reiterate, if you have high inflation, that means people are spending, that means businesses are running, the economic engine is moving forward. However, if you have low inflation, that comes from two things. Obviously high rates, which strangles spending, but also if you strangle spending, that comes with that side order of slow growth. So we have seen that in most economies filtering through. I'd like to touch up on China. I mentioned it briefly on episode 1, but China for me is that canary in the coal mine with that slow growth. We saw GDP numbers come out this morning, a lot cooler than expected, but also we have seen and witnessed that slowdown. China is a net exporting country, so if we understand that for them to keep up with demand and for them to keep up with their numbers, they obviously need countries that are importing from China. And if no one's importing from China, you can go ahead and expect those numbers to start cooling. So with Eurozone and UK inflation, how I want to position myself before I even show you on the charts, I want you to know that majority of the stance, especially for the Bank of England and the Eurozone, is data dependent on inflation being where it was. Right? We've seen inflation in the US cool quite a lot, right? And that has changed sentiment. Dollar tanked, and that has also propelled a more of a dovish Fed, and a Fed that is more than likely going to abide by a month-by-month view to see how the economy is reacting to rates at these levels. That exact same story is going to happen for the Bank of England and the ECB. It is simply a matter of when. If we understand that these levels of interest rates are still going to have that lag effect on the economy, then the stance from the Bank of England and the ECB is going to be exactly the same. So for myself, how am I going to position? I need to understand that if I'm looking at the pound, if I'm looking at the euro, I want to know that where I see the risk reward is obviously to the downside, right? And let me teach you something. Yeah, if you haven't traded for 6 months, and let's just say you looked at the markets today, and you look at the pound and you look at the euro, where is the risk reward? Right, price is obviously extremely elevated at these levels, but the risk reward remains to the downside. Right, if we do have inflation cooling in the Eurozone, cooling in the UK, that's going to bring a slightly dovish Bank of England, dovish ECB, European Central Bank, and that's going to obviously price into the currencies. But enough of that, let's jump on the charts and go from there. Right, so the euro, if you remember clearly from episode 1, euro was extremely elevated at the time, where we did have this cup and handle pattern where I did actually put it. I'll try and attach it in this video. This cup and handle pattern. If you don't know what that is a technical analysis pattern where you have this impulse of leg in the market, you have a small correction, you before that continuation. But we had this massive rally on the euro, and it was obviously cooling. We had that bit of a slowdown before that continuation. I have measured the height and size with these blue arrows over here. My personal opinion was weighted to the downside. I personally expected there to be some sort of resistance from US inflation, which would have given us a dollar higher at the time. But that is something that may still come, right? Are we going to sustain at these levels? No one knows, right? No one knows. Is China that canary in the coal mine, which is showing us this complete slowdown in growth? And is that going to have that leading effect on our other G5 currencies? Maybe, right? Maybe. So looking at euro right now, it's not about what it is, it's about where it is. 112.50 happens to be a very, very big level. If you go ahead and look back, I'm not even going to draw it in. You can just see it with the crosshair. Look how important this level is. We last traded up at these levels back in 2021 and early 2022. So very, very high price on the euro over there. And we have seen that exhaustion on Friday. Now, this is obviously data dependent. This is obviously asking ourselves, will cash be king? Will dollar come back? Right? Dollar has had this massive sell-off, breaking 100 on the dollar index. Looking at this, we understand that price was weighted to the downside. We understand that a lot of price pressures did remain because of that cooling in inflation, right? We had the Fed pause and we had inflation drop. The Friday prior, we had non-farm payroll really showing some weakness in the labor market, and we understand that's the two key factors for the Federal Reserve, which drives market sentiment. So the fact that we have had that crack a lot lower does show me that a lot more bears are coming into the market, a lot more uncertainties is surrounding the market right now. So it's up to us to ask ourselves, where is the risk reward today? Where is the risk reward this week? And I think that's a lesson for every trader listening, that you get too attached to what happened in the past, what happened last week. You want to look at it right now. And for me, I'm still going to stick to my guns and say the risk reward remains to the upside on the dollar. But if you are in the bearish camp and the dovish camp for the Fed, you can look to sell the rallies, or you can look to sell the rallies. But from a day trading point of view, understand that you can play both sides of the fence here. If we do have that weak eurozone and that weak UK inflation come out, then do expect a lot lower pricing on the pound and the euro. So GBPUSD more than likely back to 128.50, just from a technical perspective over there. That would then elevate dollar back anywhere into 101.50, 102 from a technical perspective. So this is now me looking at the corrections, but it's also me looking at the data to evaluate how if I was sitting in the Bank of England or in the ECB, what would my view be if I had to see inflation cooling? Obviously, I would take more of a cautious approach because, yes, inflation has remained elevated at these levels. But if we have a slowdown in China, we have the US inflation cooling drastically, is this a sign that we should follow and we should slow down our policy tightening too? Maybe. And that is the key there, folks. If this data this week comes out a lot weaker, we can obviously see that follow through. But for me, monitoring cable, monitoring euro, monitoring dollar, nothing fixed in my view right now. However, I'd like to add my bias on oil that I did mention on episode 1. Due to the whole slowdown in China and this whole global slowdown, I'm going to favor selling the rallies in commodities, oil being that pick for me. So this morning on my live calls, I gave the short opportunity from 76 where we just tapped. Right at the time, we just tapped that level, and it's actually good to see. Let me stretch this to the low. There we go. Right, it's good to see that price action actually follow through. We came back to tap into that 61.8 on our fib, but more importantly, $76 a barrel got tapped before that rollover to the downside. So if you are watching this right now and you want to position yourself in a commodity, what do these red blocks mean? These red blocks are simply me looking at market price and me waiting that full capitulation to the downside. So as I expected a couple of weeks ago now, we have had that reversal. Then I do favor selling the rally, any little rally that we get. So definitely a lot lower pricing on oil. I do then expect at some point this year, I do see $60 a barrel. So I see these lows coming to get taken out. There isn't enough global demand to keep up with prices at these levels. I could be wrong, so it's not financial advice. Do take that into account. This is my opinion purely. But for myself, what I'll be doing on my own account is I'll be selling rallies in oil Should we see another rally into $76 a barrel? I favor oil lower. Gold, the exact same thing. Should we see this move to the downside? I have too highlighted this with a red zone to the downside. Do excuse these highlighted drawings, but should we have this move to the downside, clearing these lows back below 1950, my view then will be to sell the rally into 1950. Right, so that being said, I just want to explain something, that my view on that is dependent on that red block. It's dependent on that initial sell-off. If that initial sell-off hasn't happened, there's no reason to sell it. Right? There's no reason to get trapped in the position in the first place. So try and keep that in mind. But with that being said, that's it really for me. We have UK inflation, Eurozone inflation, Canadian inflation, so an inflationary week. And then next week's the big week with the FOMC meeting, but that will be covered on episode 3. But folks, I'll leave you on that note. Don't forget, if you want TradingView Pro for free, go ahead and click the link in the description below or anywhere around this video and sign up with Black Bull Markets today. No minimum deposit, none of that, but you will get access to TradingView Pro if you follow their requirements and meet their criteria. But other than that, hope you enjoyed episode 2. Drop a comment below what you want me to cover in episode 3 and I'll bring that. But other than that, have a good week. Keep that risk tight. It's so important to keep that risk tight. And I'll see you guys next week, Monday. Take care. Bye-bye.